Hey there, this is Charles Goddard. That's me down in the corner losing my religion. And what we're doing here today is I'm giving you a little rundown on other uses for a quite a common indicator on the charts, and I'm also shilling a little bit my trading book. Now, I've called it a beginner's guide, but it's actually relevant for three levels. One is, of course, the rank beginner who wouldn't know a stock chart from a burnt biscuit. You start with go through this book, and I guarantee you'll be trading properly by the end of it. Level two is the trader who's having trouble with consistency, and I know what ails you. And I've got bad news. It is you, and but I've got solutions for you. And level three would be the trader that's doing okay and is just looking for a refresher, which is quite common. A lot of people like to go back and look at the foundations of charts and trading. Now on this page, then we've got a link to that book and video package. It's not just a book, there's some videos that go with it. And on top of that, just for going and taking a look, you can grab a couple of free books without needing to buy anything. And yeah, don't worry about me. I'll be just fine, thanks. But anyway, on to the important matters, which is how can we make the best use of the rate of change indicator that we find on so many charts. So let's take a look. Okay, so here we are with our chart of the S&P 500, and this is a monthly chart. This means that each candle on this chart represents a month of price action. It's a fairly compressed chart because we're covering a lot of years here, and there's points I want to make on it. So the vertical lines represent the points where we've got a high in price which is not matched by the rate of change in the panel below the price panel. Now, this kind of setup is very appealing to me because it is available anywhere. You can get this free on the internet, which my understanding is available on most computers these days, or you can get it from your trading platform. You may need to ask, because I could tell you that some places, banks mostly, aren't aware that they've got this charting service on their investment platform. So you might have to pull that out of them or waterboard them or something. Anyway, so the what we've got is a different use for rate of change and the divergence. So the fact that the price on the left in the year 2000 has risen to a peak, but the rate of change just below it has not risen to a new high, tells us, okay, there's a divergence here. Now, first of all, I wanted to warn you that divergences don't always show up, but this is a leading indicator. When they do show up, you need to heed that warning. So there's several things we would do on the appearance of a divergence such as this. One, we could tighten our stops, we could take some profits, or you could follow the same course of action as me, where I put a trend line on the price. You could see a rising arrow trend line there, and if that trend line gets crossed, then I am out of that position. Now this happened back in 2000. I was a financial planner at the time, and I was a little frustrated at how the beating that my clients took, because nobody moved anything around for some reason. I won't go into that now because it's too aggravating. But I decided that that was not going to happen again, and embarked on a course of study that took some years and quite a bit of effort, and changed my interaction with clients to one of more hands-on management of their investments. But what I did was I went back to that scene of the crime and said, okay, if I'm going to give money managers a tough time for their lack of action, I need to I need to go back and look and see, well, would I have done any differently? And when I went back to look, I could honestly say yes, I would. And that was proven out in 2007, sorry, when the price rose again to a new high, um, and that's a high over. Usually, I rate them over 6 months, so several years have gone by, and that's a new high in several years. But there's not a new high in the rate of change beneath. So on goes my trend line, and I'm out, and all my clients have gone to, I've taken them all to the sidelines, and none of them lost a penny in the train wreck that followed. Now, if we track this on from there, what we find is the S&P has risen substantially over a lot of time and a lot of points, thanks to a lot of easing and juicing and whatever. And so now it's actually an unholy thing. And but we can see the same thing has occurred. We've got a high in price on the very right-hand side of the chart, and we don't have a high in momentum. So what comes next? Well, on the next slide, I've expanded this chart a little. So let's go take a look at that. All right, there you are. I was just beginning to worry about you, but okay. So here we are on a daily chart, and what we've got on this charting service is we've got the rate of change in the top panel instead of the middle panel, and what you can see, this first of all, the key difference in the charts is that each candle represents daily price action, and the previous chart, each candle represented a month's worth of price action. So we've got a high in price. We don't have a new high in momentum. On goes my trend line. The price crosses below that trend line. I am out, and as you can see, that anybody that followed the same course of action would have avoided a mighty fall. And that fall, in terms of the short amount of time and the sheer amount of points, was I think there's been 4 such declines since the late 1800s. So quite significant, and this simple little method would have kept people out of it had they been aware. So now the other thing that I wanted to mention about the rate of change that a lot of people are not aware of is that we can use this indicator to trigger us into trades. In other words, just the indicator itself, its movement, it's crossing certain lines, and would cause us to get into a trade. And once we're into that trade, that indicator will also help us project the a price target for that trade. Now, these things are not they're not well known. Most people like to use the indicators such as this for overbought and oversold positions, which I don't have a lot of use for just because of the way I operate, and I just honestly I don't see the value of an oversold position that can go on for a long time with the price still chugging along, and you're sitting in oversold, and I don't know what the heck you're doing with that. But anyway, so if you're interested in learning more about this indicator and how I use it, I've got a PDF. It's just a few pages, but it tells you in detail how this works. You can use it with stocks or commodities, whatever it is that you trade, and I think you'll find it quite informative. So how you get your hands on this little treasure? Well, let's move on to the next slide, and I'll tell you. Okay, so I know what you're thinking. You're thinking, I saw that slide before, and you'd be absolutely right. Sorry about this. My camera slipped a bit. So contact information is there again. my email address if you'd like to drop me a line to get this this PDF that really does give you some good information about a much better way of using the rate of change, or the MOM as it's sometimes called. And that trading method that I mentioned has got a 75% plus success rate. So if you're interested in seeing that, then like I said, drop me a line. I'd be most happy to send you that PDF. And then of course you've got the link to take a look at my book, the video package, and some freebies are available to you there as well, as a thank you for taking a look. And I just want to say thank you for taking the time to give me a listen today. And if I could be of any help to you at all in understanding how the markets work, how things are put together, then please don't hesitate to drop me a line, and we will maybe talk in the near future. Take care of yourselves, and bye now.